Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get to Adobe, worst performing stock on the S&P, down almost 14%. Weak sales outlook for the current quarter. That's the key. And it's all about worries now about AI startups being a big threat to the company. So let's get more here with Brody Ford. He joins us. He covers tech for Bloomberg. So what happened?
What happened is last year, if you asked investors who's going to benefit from AI in 2024, they'd say Microsoft and Adobe. Ooh. But after last night, it might be just Microsoft for now, right? Because Adobe has invested massively in new AI features, trying to improve a lot of processes in Photoshop, Illustrator, other programs. But we're not seeing a revenue uplift yet, right? Investors expected that these new features would drive a lot more financials in the new year. And we're just not seeing that yet, and they are not keen to wait at this point.
I mean, was that reasonable for investors to think that the revenues would be coming in at this point? Because I feel like they've just developed these new products, give them a minute.
Yeah, I mean, I think management's been pretty consistent in saying right now we're pricing for adoption. We're trying to just get more users. But I just think it's not quick enough for investors, especially when there's this sense that many other AI startups out there are not moving so conservatively, right? They're going to create tools like we all saw OpenAI's new Sora, which allows you to generate video, right? Something like that gave investors a lot of anxiety because they said, whoa, are people even going to need to pay for Adobe's tools if this becomes mainstream? Right. So that's where a lot of this anxiety is stemming from.
So also, don't they need people like me who's not use it for free and come in and pay for stuff? Mm-hmm. How are they going to, aside from the AI conversation, how are they going to make me, who wouldn't know Adobe if it hit me in the face, come in and start to pay for some things?
Yeah, so I mean, their primary user base is the kind of creators, graphic designers,
the fancy
movie
people.
Studios. Right. They are increasingly trying to break into people like you and me who might need to every so often, edit the margins on a photo or recolor something. And so they've invested.
Help Kate Middleton. I mean, it's a whole thing.
Right. Exactly. If they had a more unscrupulous marketing department, I'm sure they would have leaned into the whole Kate Middleton.
Oh my God. Yeah. Don't do what she did. Use our services.
Yeah. If she had Adobe Firefly, that never would have happened.
That's pretty funny.
Yeah. So yes, I mean, they have invested more in trying to get average users using their stuff. That was a big cornerstone. I don't know if you all remember, they tried to buy this company Figma for $20 billion. That was part of that planned acquisition that, hey, this company has been good at putting these complicated tools on the web, making it simple, making it so that average people can use them. We've had trouble with that. Let's just buy them.
That's an interesting idea. But I guess I want to get your take on the bigger picture here. So in the long term, AI, do we really need Adobe software? I mean, is this the tale of a buggy whip manufacturer grasping at the last straw when the whole technology has moved on?
Yeah, and there was this rare candid moment on an earnings call last night where they kind of had this argument a little bit, right? Some of these Wall Street analysts said, we understand that in the near term, people will need Adobe's tools to edit the video, edit the photo. In the long term, are you going to get displaced entirely? Management pretty much said that you will always need something to, you're not going to generate a whole video just with a prompt and publish out there. I think the quote the CEO used was, the next Oppenheimer is not going to be created with a prompt. But it's an open question, right? As the decades go on, the current format of Adobe's tools, which is, these kind of heavyweight applications on the desktop, think about like Photoshop, video editing, picture editing. Will these formats really still exist once you can generate so much more media with a prompt?
But, I have two schools of thought on that. Like, one, people who want to do that, they want to do that. Yeah. Like, they're creative people that enjoy it. They don't want to just put in the word flower and, get a picture, right? Mm-hmm. However, do they have tools where you can put in the word flower and create a picture? Like, are they working towards that?
Oh, yeah. I mean, okay. They're
in it. Like, they're in it.
Yeah. I mean, Adobe has pretty much spent the entire last year working quickly because other AI startups did this first, to make these kind of tools where you can type in, like 4 journalists sitting around a radio booth and it generates the image pretty well, right? And to your
No, don't do that,
I
guys. No. You need us because we are unique and awesome. Okay, go ahead. Sorry.
No, to your point, do creatives like it? It gives them some anxiety, no doubt, but they need to get paid, right? And at the end of the day, if the bosses are saying that, hey, this is a pretty good tool, we're going to be able to create things faster, the incentives are all there. I don't think the idea that people are anxious because AI might replace their jobs could reduce the adoption of it. I don't think that will be really a prohibitor here.
That's so interesting, though, because ever since this generative AI mania came about, the whole question is, what's this going to do to jobs? And a lot of the response has always been, it'll always be people working in conjunction with AI. Yep. But the thing that makes me think about your Oppenheimer comment that was made on the call, I think that's a very telling comment, because that Academy Award went to the one person, not the one person in Hollywood, a prominent person in Hollywood who champions the old school way of doing things, shooting things just on film. And so that kind of leads me down this path of thinking, the Adobe software might stick around for a while, but it might just become very niche or something for a very specified sort of area of use, whereas the rest of the world is just going to move on with doing things with a couple of prompts.
Totally. And the big question is, will companies reinvest, right? Because these are labor-saving technologies. Will it be that, hey, I'm able to do more with each person so we can expand the scope of what we do? Or are we going to do what we currently do work-wise with less people and just save a bunch of money and employ less? And I think we're deluding ourselves if we don't think that companies are just going to cut labor. At least some of them will.
Yeah.
What else are you looking at? What else is floating your boat right now?
I think a really big one is how soon we are able just to generate these videos with prompts, right? This demo we saw from OpenAI was such a kind of extreme example of this technology. And the big question is this really ready for prime time, or is this one of these demos that you show that isn't actually going to be in our hands for a couple of years?
Yeah, I guess that's always the question, though. And it's we're believing the hype, or we're lapping up the hype, any example of how cool this could possibly be. But this is the question for all companies. You've got to start putting real money behind it. And sometimes it just doesn't work very well, or there's tweaks in the machine that makes you think I don't like this response.
It looks, and I'm sure you all saw the controversy of Google's equivalent of the image generation. It had a lot of backlash in recent weeks because it would, if you typed in a certain historical element, some of these tools are made to, emphasize diversity, and some folks, there was some backlash to that in historical context where maybe it wouldn't be accurate. And so there is a lot of people very closely scrutinizing the outputs of these machines, right? There's no precise way to make everybody happy with these.
Yeah, I guess a lot of programming needs to keep happening, and it's a question of whether the money will still be there from companies to pay for it.
Well, Brody, thanks a lot. You were awesome.
Thank you.
Having you on. Your depth of knowledge is great. Brody Ford coming in there, Bloomberg Tech, and you're looking at Adobe. Where'd it go? I had it, and it went away. It's down. What, 17%?
It's real down.
Yeah, it's real down. Around 17%.
Yeah.
14%.
14. Thank you. Had a buyback. Though as well. It's hey guys, stick around. We know we're not delivering what you want right now, but please stick around for that. I do think your point is taken, Jen, that everyone seems to say you will use AI, but you need humans to help it. It's not maybe going to be as binary as maybe we thought a couple years ago.
Yeah, you need humans, but maybe to Brody's point, you don't need all those humans,
right.
Just a couple of humans.
But which is why you need people like us to want to diversify into, Photoshop to do that. My dad does that. He takes photographs because he likes it, and they need tools around in it. You need those people to kind of pay for that stuff that is irrespective of AI, but is that really going to move the needle then for a company like Adobe?
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Apparently, Boeing is now advising airlines to check the cockpit seats on its 787 Dreamliner jets after a seat mishap likely pushed a pilot into the controls, causing a sudden, terrifying plunge on a flight to New Zealand this week. The flight attendant was serving a meal, and therefore all of this wound up happening. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joins us now. I mean, this feels like, okay, yeah, it was a mess up. Big deal?
I'm sorry, I didn't catch that.
Big deal or no?
No, I don't think it's a big deal. I mean, if you were on the flight, obviously it was a big deal, and so we hope everybody's safe and okay after that. But, you know, the 787 has been operating for a lot of years now. This is the first of this incident I've heard of. It sounds like there might not have been a safety device in place that allowed the seat to be adjusted. And so my guess is Boeing, out of abundance of caution, has pushed out to the fleet, you know, hey, make sure that this plastic cover or whatever safety piece is in place and you don't adjust the seat by mistake. And but again, I think it's not a major issue. Right now, there's definitely a heightened amount of awareness around anything that happens in a Boeing airplane. I think it's a little bit of that.
I take your point that it's not a major issue in terms of this particular type of jetliner, but I do wonder about what the read across is going to be for the average consumer, because they're not short of news from Boeing that they've seeming to have one mishap after another. And I wonder if consumers are really going to be able to make the distinction between this jetliner versus that jetliner.
Yeah, agreed. I mean, I've seen a lot of press on every little thing that happens on any Boeing jet right now. I think, you know, clearly it's getting a lot of clicks, and so the media is going after it pretty hard. I think at this point we're still in this situation where, as the problems with the MAX fade, I think some of the demand for these stories should fade. I don't think most people are going to the airport worried about what airplane they're flying. I talked to a lot of people you know, about where they're flying and what they're flying all the time. I'm an aerospace geek, so I'm still hearing people that aren't in aerospace say, hey, yesterday I knew I flew a MAX, but they're still getting on the airplane. So I think, you know, we're not at that point yet where people are sort of rejecting flying Boeing products, and I mean, that's a positive for Boeing, obviously.
I think, Jen, for like a hot minute, maybe it was on Priceline, you could search the type of aircraft after, I think, the panel blew off and stuff, and you could search your aircraft.
You could. That's got to be totally a function of consumer demand.
Yeah, but I wonder how many people actually cared or looked at it, to George's point. George, in the meantime, we learned a lot about the airline industry this week. There was a conference, I think it was JP Morgan, right? Then airlines, particularly Southwest, was warning of, in essence, some slowing demand. What are the order books like for Boeing? Like, how are they navigating that with their customers?
So, I mean, the order books are really, you know, the backlog is very strong for Boeing. And so, like on the 737, 5-6 years worth of backlog on that airplane. That's why it's so disappointing when, you know, one of their major customers like Southwest comes out and says, you know, we've been told by Boeing we're not going to be able to get this many jets, all the jets we wanted this year. There's a lot of work to be done for Boeing, and that's part of their recovery story, is increasing build rates, which is going to boost their profits, boost their cash flow. A lot of folks were looking for that to happen this year. When someone like Southwest comes out and says we're not going to get all the airplanes this year, that means we're kind of set back another year. But that you know, they need to start to build that backlog and keep those customers happy so they don't go away. The longer the delays happen, the more risk there is that customers have an out in their contract and can walk away from their orders. But the backlogs are very strong for the 737 and the 787. Its major competitors, the A350. The 787 has a larger backlog than the A350, been in service a long time. Airlines love it. So right now, backlogs are very strong at Boeing. They just have to start building airplanes well.
Looking at the Boeing stock year to date, it's the second worst performer in the S&P 500. I mean, when is the stock story going to start to turn around?
You know, I mean, that's always hard to say. I think you need obviously some level of sentiment to change for people to be excited about this. You know, I personally think that this purchase of Spirit Aerosystems that's been floated, I personally think getting that done could put a bottom under the problems Boeing's having in their manufacturing process, and that getting that bottom underneath, I think, you know, that this quality story, that's going to be key, I think, to keeping investors happy.
All right, George, really appreciate it. Thanks so much for hopping on with us. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
University of Michigan sentiment, as John Tucker was just reporting, falling just a bit. Let's get more data on it with Joanne Hsu, University of Michigan Surveys of Consumer Director. She's breaking it down right now. Okay, so Joanne, what happened here?
Essentially, not a whole lot. Consumer sentiment has been remarkably stable over the last 3 months. We've had very little movement since January, and that's following the enormous gains that happened in November and December, between November and January. So not a whole lot of change. Consumers don't really perceive any sort of clear developments in the economy. Possibly more importantly, inflation expectations also remarkably stable. Consumers still expect inflation to slow down both in the year ahead as well as the long term.
We've been talking so much on this program about where investors are expecting the Fed to go. Can you dig in a little bit to what you think consumers' read is on what interest rate cuts are coming? I mean, do they feel confident? Are they a little bit more enthusiastic than investors are, perhaps?
Consumers are expecting, broadly speaking, they are expecting interest rates to come down over the next year. And, that was a pretty sharp change in consumer views or consumer expectations over interest rates over the last 3 to 6 months. So even though most consumers really aren't paying that close attention to developments in financial markets, more broadly, they do expect the interest rates that they face to come down. We don't really know much about what they're thinking in terms of timing, but every month there is an increasing number who expect interest rates to soften.
Do we read anything from the fact that things are just slowing over time? Like, is this sort of the tightening that we've been waiting for and the consumer sentiment a bit lighter so they just buy and spend less? Like, is this kind of what we've been waiting for the last year and a half?
It's possible, but it's part of the thing is that, excuse me, part of the reason that consumers are not really moving a whole lot in the sentiment is that there's a good chunk of consumers who are thinking about the election ahead. And, and a lot of consumers are telling us spontaneously that the trajectory of the economy very much depends on the result of November's election. So I think there are people who are just reserving judgment right now. Whether that's going to affect their spending is a little bit hard to say, because I think, even though they're reserving judgment, they're still expecting two possible outcomes, we'll see in the months ahead as that comes into focus, if that starts to move sentiment one way or the other.
I noticed that in your data you do poll Republicans versus Democrats versus independents on how they're feeling. So is there any interesting change there this month?
I would say it's a little early to say because, at the preliminary reading, we don't want to draw too many conclusions out of small samples, divided into 3 different parties. What I will say is that this general stability that we're seeing, we see that across party as well. So the enormous gains in sentiment that we saw November to January, and then the stability between January and March, all 3 of both of those patterns are visible across Republicans, independents, as well as Democrats.
Interesting. Hey, Joanne, we love it. Thank you for the instant analysis. It really helps us as we get through all the data here. Joanne Hsu of University of Michigan.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get the take on a market here. My daughter's making animal sounds. Sit down. Don't stand on the chair. All right, looking at a market here where we're trading a little bit heavy. Yes, it's options expiration, triple witching, volume super high. But, I'm trying to understand if we're going to be looking for bad news or good news and what the reaction function is for stocks. So Dana Dioria is Co-CIO of Envestnet, and she joins us now. Dana, what are we waiting for at this point? Like, do you need to be selling into this? Do you buy whatever dip? What do we do?
Yeah, it's a great question. I think, we've been buying. There's been plenty of buying going on in this market, I think. Actually, I think, what we're seeing now is, of course, the market slowly but surely getting to where it's hard to understand why we maybe didn't start there, right? The market contending with, it's probably not 6 rate cuts. We're past that. Question is it even 3 at this point, all else equal, right? Not knowing what we know now. And, if that's the case, I guess the question becomes, does it finally start hurting some of these growthier stocks where, in spite of the fact they have, longer dated cash flows, we know traditional would say that higher for longer, should be more painful for them. If they're self-funded, they're really not feeling that pain. I think, it's kind of more in small caps is an interesting place to be thinking about. They're more interest rate sensitive. Does higher for longer, how does that impact them? But there's pros and cons there. My take is actually to keep tilting a little bit into that space, especially if you can wait it out. They may be interest rate sensitive, but if inflation comes back, small value in particular tends to outperform inflation. So there's push and pull in this market, but I think the overall theme is, wow, maybe we're not going to get these rate cuts we were hoping for.
I mean, can you talk a little bit about your views on the balance of risks for the Fed? I mean, do they have a lot to lose by waiting, a lot to lose by moving too quickly?
I think they have more to lose by moving too quickly. Their mandate is employment and inflation. And really, both of those are signaling the same thing, that it's not time to cut, right? So we have PPI coming in a little higher than we wanted, core, inflation a little higher. Obviously, these are not extremes. We're not seeing a bounce back or something in inflation yet, but we are seeing stickiness to inflation. And, the history suggests inflation does kind of come in waves. We've seen a lot of macro analysts talk about that. So the Fed, of course, is well-versed in that. So they're probably worried about that. They're also looking at these employment reports. Unemployment ticked up a little bit, but initial jobless claims look great, right? The employment picture looks pretty sound. So if your mandate is employment inflation, both of those signals are saying, why are we cutting right now? And I will say, look, on the other side, well, one other signal saying why are we cutting, of course, is the stock market itself. It's not like, we're feeling a lot of pain there. We're certainly not. Small, areas of the market. But not the market overall. I will say, if there's, you said pros and cons, right? The other side of it for the Fed, if there is some, and I don't think this is the decisional part, but we do have a federal debt that's climbing dramatically. We do have cost of, maintaining that debt. The higher the interest rates, of course, and the more that debt rolls over, the worse it is. So, to the extent that impacts on the Fed, that is in the mix.
So if we're dealing with all of this, is it a commodity situation that you need to be playing right now? I'm just looking at month to date. The S&P Energy Index is up almost 7%, whereas you have WTI also with a nice move, month to date up a little over 3%. It's a little softer today, but copper at 11-month high. Like if we're in for a period of, we're going to get stickier prices, we're not sure what the reaction function is from the Fed, it's going to push off rate hikes, just buy the commodity sector?
It's a thought, right? There's definitely a camp who would say yes to that. And especially too, if you think inflation might be stickier. Of course, there's a whole, school that says that that's a place to be to tackle inflation. I don't know if I come in really in that camp. Not to say one way or the other. Obviously, demand, there's several variables that are going to impact on that. And energy, of course, very dominant in that sector. But I guess, from the standpoint of just what am I trying to protect against, the commodity sector is pretty volatile. If it's inflation I'm trying to protect against, tips is probably a better place to be if I'm specifically looking there. And if I'm in equities, and as I mentioned, small value in particular, I can go there and I have a reason to productive capacity, right, to earn returns over time there versus maybe just, betting on a commodity, betting on a price increase because of supply demand issues. So my personal preference is more along those lines. It's not to say you shouldn't be in commodities, but I don't put a big stake in the allocation there.
So just one last question for you. Getting into the second half of the year, presidential election campaign coming up, there could be highly partisan activities going on around there. What should equity investors be looking out for?
Yeah, understatement of the year, right? Definitely, we'll see some partisanship. I'm with you 100%. Look, I think there's a lot of academic evidence, a lot of empirical research that says you can draw a good correlation between who's in power, whether it's presidency, Senate, House, all sorts of think of the matrix of which in power for each of those. It's all been looked at. It's really not definitive which, configuration is better for markets. Obviously, if it was, you'd have that party really singing those phrases. But so I don't, from that perspective, I don't think there's a lot of information content, but I think you nailed it. It's the volatility, right? It's the fact that the market vol, and actually you're seeing VIX, futures in VIX reflect this a bit, that around October, all of a sudden, a spike in volatility is probably coming for the market. So I think you're absolutely right. I think expect kind of bumpiness the election season. And as we all know too, globally, there's a lot of elections going on this year. So overall, that could be, not just in the S&P 500 and US indexes, but globally as well.
All right, Dana, thanks a lot. Really appreciate it. Dana Dioria, Co-CIO of Envestnet, joining us there. But the interesting thing is, if you played volatility or election volatility or geopolitical risk, it hasn't paid off. Like, you had a brief momentary thing in 2016 with Brexit. But the hedging window of making money just gets smaller and smaller with these things.
I know. So if that's your move, then you've got to think of another strategy, because I'm looking at the VIX right now and it's at a pretty low level.
Yeah. And if anything, everyone's buying calls to play the upside, or selling calls, not necessarily hedging their bets when it comes to puts.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I think they do have Shamrock Shake still at McDonald's. I'm not gonna, don't quote me on that, Tucker, but I think it's possible.
Well, at least, for St. Patrick's Day is the 17th on Sunday.
I mean, I feel like that's okay. I mean, do you want to know the calorie count for that, or you're good?
I actually did check the calorie count for the large. It's 800 calories. Could you imagine?
That's a something.
Just one drink.
That is a something.
Breakfast and lunch right there.
Combine that with a Big Mac, large fries. You're set for a week.
Yeah.
Oh, they can have reduced fat ice cream, though, so that's something. But that's only if you can order it, because apparently there was an outage. They experienced a system outage. It appears to have started in the Asia-Pacific region and spread to other markets globally, leaving customers unable to order at its stores. It's huge. So we have to get more on this. The stock is just down by about 0.4%. Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst, joins us. Now, what happened here?
Nice segue, by the way.
Thank you. I mean, I do this for a living, but it's a hit or miss for me. It's 50-50.
Can't all be winners, I guess, but that was a good one. So I'm not really sure how many stores in how many countries were affected. So far, from what I could cobble together, it looked like a couple dozen countries, and it wasn't all of the stores in the countries had this digital outage, so people couldn't order and pay with their mobile apps, right? And they had trouble ordering ahead on I mean,
I can make fun of it, but if that happened to Starbucks, I'd freak out. So it's a fair.
Well, because you're addicted to the caffeine in Starbucks, you're not addicted to the Big Mac, right?
Well, think of the people who are addicted to the Big Mac.
It's painful.
Exactly.
It'd be hurt. Yeah. Think of the people who want that $800 calorie Shamrock shake. It'd be a really expensive shake if that was the case. How is McDonald's doing?
So I guess what I was getting at is it's going to be negligible, the impact on their earnings. It'll, it'll be, we're talking about like a few basis points maybe impact to the global same-store sales for the quarter. But McDonald's is doing really well overall. Last quarter they started to talk a little bit more about the low-income consumer and how they're kind of pulling back on their spending, visiting less often, ordering more off of the dollar menu and things of that nature. But overall, the company is doing really well. They are having some issues in the Middle East, however.
Yeah, can you talk us through that? It looks like the CFO announced something at a recent conference.
Yeah, and they mentioned that same-store sales for their international and developed markets are going to be lower than expected, lower than consensus, lower than they were last quarter. And so I think most of the street had thought that initial impact of some of the things that happened with their franchisee and perceived support of Israel over Hamas hurt sales in the region. And I think a lot of investors thought that would kind of roll off after fourth quarter. But it looks like it's going to impact their results for longer than expected. I mean, it could last throughout the year. McDonald's does have exposure to Egypt and Jordan, two countries that are geographically very close to the conflict. So that's going to impact their results as well. And it could be a few quarters for this impact to kind of to roll off. What I'm hearing is it is improving. Things are improving, not only with the American chains, but also locally. But it's going to take time.
So I'm looking at the stock. Just this week, in the last 2 days, it's down by about 5%. Do you feel like that's accurately reflected now in the stock price and valuation, or is there just a little bit more downside? Is that ego, or is it actual Middle East issues? Or he's kind of laughing at me, and I don't know.
Well, I work for Bloomberg Intelligence. Am I allowed to tell you what's priced in and what's not priced in? I mean, listen, on the valuation, it's interesting. We're in an interesting spot for restaurants right now. So the stocks have done really well over the last 6 months or so. I think we've passed the toughest year-over-year comparisons in January and February. So the year-over-year compares are getting easier throughout the rest of the year on one hand. But on the other hand, you have a weakening consumer, especially the low-end, middle-income consumer, right? And so it's tough to say. I mean, you can make the argument the entire space is overvalued, right? So maybe that 5% correction, maybe that's not enough. It's very difficult to say. Like I said, we're point now where it's going to be really, really interesting. And I think what's going to happen is we're going to see a bigger divergence between the winners and the losers. Companies that are doing really well, companies like Chipotle and McDonald's that have been able to draw in some of the higher income consumers, I think are going to continue to outperform some of these other chains that haven't been able to do that to the same extent, like a Wendy's or a Cracker Barrel. So it feels like it's getting back to a stock picker's market for restaurant stocks, which is great, which I love. So we'll see. It is a business where you have to compare, I think, these restaurant chains where versus their peers. And McDonald's gets a premium valuation, but it also has outperformed.
I would love to go back to this point you were making about consumer spending and getting which chains are getting the wealthier customers. I mean, because we definitely saw a trend of casual dining moving to fast casual moving to quick serve. And so where are we now on that? Is with inflation pressures easing, is that kind of unlocking a little bit?
We're still seeing this K-shaped recovery. We're seeing, that's what we're seeing. So we're seeing the high-end consumers. We think they're going to start spending again this year. Fine dining, they had the toughest comparisons. Last year, fine dining did absolutely terrible. People visited less and they spent less. They bought less expensive wine, things of that nature. Now, with asset prices going up, we think that high-end consumer is going to come back and spend a lot more. So I think we're going to see fine dining recover and probably outperform a lot of the other subsegments of the restaurant industry. And I think casual dining is probably going to get pinched the hardest. It's a similar lower and middle income consumer to fast food, but fast food is cheaper and fast casual is cheaper. So I think people are going to go and spend their money where they think they get better value for that dollar, right? And casual dining, that full service experience, you're going to pay a tip. You're more likely to buy drinks, appetizers, desserts. So the bill ends up being a lot higher than it would at the fast casual.
Also, fine dining now, forget it. Regular dining is now fine dining, right?
Exactly.
$300 for 3 people.
Can I point out an Achilles heel? I think from the suburban perspective for McDonald's, the drive-in where everybody goes. You don't go you go through your car. I go to my mailbox in my car to get the mail. That's a disaster. You pull up, you order, you pay, and then you go to pick up your food, and consistently they tell you you have to go park and someone will bring your food out to you later. That's not fast food, and it's annoying. Because
it's too much. They can't do it.
They just can't
understaffed.
do it. Understaffed, and that's
in the restaurant. Yeah.
A lot of the restaurants. So that's such a pet peeve. Every time I go, and I haven't been in a long time, I say to myself, I'm never going back to McDonald's.
And that's why they're pushing you to order ahead. They want you to order ahead, and they have the geofencing, so you can order ahead on your mobile app. Once you pull on the lot, they're alerted that you're on premises. You park in the spot, you hang out, you look at your phone, look at Instagram for a couple minutes, and then they bring out your food.
Yeah, this totally described what Tucker does, for sure. That Instagram, and he's like, I got a few minutes.
Way too many
But before we let you go, though, but then to that point, what are their margins like? Because input costs and inflationary costs, and then you have labor costs. And I'm wondering, are they if they can't really pass it on, what are their margins looking like?
Well, the franchisees are getting squeezed. There's no doubt about it.
Mm-hmm.
I mean, the beauty of being a franchisor like McDonald's is their margins are fantastic because, you know, they're really a marketing company, right?
Mm-hmm.
Like they're helping their franchisees market the brand and the food. So, yeah, but franchisees are getting squeezed. There's no doubt about it. This year, commodity price increases are going to be less than what we've seen. But chains are very, very wary about raising prices anymore because we've seen traffic decline a lot over the last 3 years, and it's been in response to much, much higher prices.
Michael, great stuff. Really great to have you. Super interesting conversation. Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst. But then you would think, Jen, that like the people who don't want to go out to eat anymore or don't want to go to casual, like do they then trade down? And is there a new customer that's going to be coming in on a more consistent basis as things get harder? I don't know.
I don't know. And the thing is, I do always wonder about the low-income consumer because if that spending starts tailing off, what does that say about consumer spending for the rest of the economy?
It's not good.
70% of the economy.
Yeah. There's a really great article on the Bloomberg that talks about how auto debt, for example, and credit card debt has really been rising and that people might be getting paid more, but it's the debt part that is really squeezing everyone. I encourage everyone to read it. It was really eye-opening to me.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.